It's time now to talk about this fundamentals of credit analysis reading. This is an interesting reading, and it's something that gives you an idea of how a bond rater might look at a particular fixed income credit, so that we can go through and think, well, what makes something have greater credit worth or less credit worth, as well as some issues associated with credit risk and default that are good to think about. And it's not a particularly difficult reading, but I do think that it adds some insight into the idea of credit analysis. So this is a good one. So, credit-related risks. So we'll start off by talking about a couple of risks here. And if you talk about the general, base case corporate bond, and you ask somebody on the street, what's the main risk of a corporate bond, they'll probably look at you funny because they don't know what a corporate bond is. But if you explain it to them that it's this mechanism that firms use to borrow money, that is, they sell the bond and that's how they bring debt capital into the firm, then they would probably tell you that the primary risk is credit risk. So we spend a fair amount of time thinking about credit risk. It's just something that is on the minds of lenders, right? So we're lending money, and the idea that that money's not going to be paid back is going to be something that you're going to worry about on some level. So that's, like I say, this is a primary risk on most people's minds. So what do we need to think about when we think about credit risk? Well, credit risk by itself is incomplete. So when people say credit risk, what they mean probably is default risk. That is the idea that the investor or that the borrower is going to cease making payments, or perhaps this could mean technical default. They're out of compliance with debt covenants, those types of things. But that's only half of the equation. So if you're going to think about the probability of a firm defaulting, then you also have to think about the loss severity, right? So if a firm defaults and they have lots of assets and the bankruptcy courts take control of those, or the trustee takes control of them and they liquidate them and they pay back the bondholders everything they're owed, well, that is not a terrible scenario. On the other hand, if they default and what we find is they've got a couple old bicycles sitting to the side of the warehouse and they owe several $100 million, well, that's going to end up being a really bad scenario for the bondholders. So it is not just a function of default, it is also a function of loss severity. So the expected loss is going to be a function of these two. So the probability of default or default risk times loss severity, well, the higher this expected loss is going to be, of course, the higher the risk associated with the credit on this bond. So recovery rate, 1 minus the loss severity in percent. So if we say, okay, this bond's defaulted, but we had an 80% recovery, what that means is that the bonds did in fact go into default. There was probably bankruptcy courts involved, but the bondholders actually, or in the end, got back 80% of what was owed them. So again, not what we're looking for when we buy bonds, but certainly a lot better than if the recovery rate had only been 5%, right? Okay, so credit risk. Again, that primary consideration. Let's move on and think about yield spread. All right, so yield spread, this is measured in basis points, and it's quoted relative to the default risk-free bond with a similar maturity. So you can think of this as the return on a standard investment grade corporate bond minus a treasury security, and we're going to proceed with the convention of calling the U.S. Treasury security risk-free, although we all wink and grin when we say that, right? So anyways, what do we mean by this yield spread, and what's the credit risks that are related to that? Well, remember, the wider the spread, the lower the price, the narrower the spread, the higher the price, right? So all else equal, if you think of, a spread for the comparison bond, in this case, we're using the example of the corporate, okay? Well, if you have a wide spread, okay, you have a higher required return, right? So higher the return, the lower the price of the bond. So if you have a lower spread, then you're trading closer to treasuries, okay, then you're going to have a higher price. So when we talk about yield spread, it's just the spread between those two. Spread risk is the risk that the spread is going to widen. And we can think of it in terms of yield spreads, because if we had this spread, well, interest rates can go up, but the spread hasn't changed, right? So, but even if interest rates go down, okay, the spread can get wider, meaning that your bond is going to underperform. So relative to the market, okay, if the spread widens, okay, you are going to underperform the market. couple of reasons for this to occur. One is credit migration. That's what probably comes to mind first. And that's the notion that, look, you bought this bond, it was rated AA, and it got downgraded. So the rating agency went in, looked at the parameters again, operating results have deteriorated, and they downgraded to a single A. Well, that's likely to increase the credit spread. Okay, there's also this idea of market liquidity risk, and this is just the idea that all else equal, investors in securities, or actively traded securities in particular, are extraordinarily focused on liquidity. So if the liquidity of the bond changes, then that's going to change the spread on the bond. So the lower the liquidity, the higher the risk. That is the risk that you're not going to receive the full market value, if we want to call it that, when you're selling the bond. Well, the higher the liquidity risk, the greater the spread on the bond. So what about the seniority? Now, when we talk about bonds, if you take a look at a big operating company, whatever, IBM, what you're going to see is that they have lots of different bond issues outstanding. So we have lots of different bonds from the same issuer, and they could have fairly different claims or seniority, or very different seniority in the priority of claims. Now, of course, the higher the credit worth of the company, that means that, the rising tide's going to raise all boats. So even if we're talking about subordinated debt, well, subordinated debt in a highly rated company is better than subordinated debt in a low rated company. But within that company, we can have very, very different claims based on seniority. So we can talk about first versus second liens if we're talking about secured debt. So a first lien is going to be more secure than a second lien. So you got a first lien on downtown Manhattan real estate. Well, then that's if the issuer were to default, you're going to have first claim against the value of that real estate. If you are the second lien, then you've got to stand in line, wait till the first lien is completely satisfied, and then you can step in. So first versus second lien, we can have secured versus unsecured. So if you have a first lien against Manhattan real estate, that is a first lien and it's going to be secured. And then a second lien would be, of course, the secured, but it would have a second position, versus unsecured, oftentimes called a debenture. So an unsecured bond is one where there's no specific collateral. It's just backed by the full faith and credit of the company, which basically means it's an IOU, perhaps a long-term one, but nonetheless an IOU. So secured versus unsecured, and then we can also have senior versus junior versus subordinated. So you can have senior secured or senior unsecured, junior secured, junior unsecured, and subordinated, right? So subordinated is going to be the lowest. And if we have subordinated unsecured debt, that's probably that should be, within our framework here, the lowest priority in the payoff hierarchy. What we mean by that is if we have to liquidate the firm, we're going to, there is a legally mandated priority. Now, we'll say more about that in a couple of moments, but at least as a starting point, there's a legal framework for how we pay off those people that have claims, or those entities that have claims against the firm. And we won't go through all of that since it's not part of the curriculum, but basically once we get down to the bonds, the first lien against some secured asset, they're going to be in a pretty good position. When we get to the unsecured assets, well, we're going to start with we'll start with senior, then go down to junior, which are going to be greater than the subordinated claims. So how far down can we go and pay everybody off is the question. If you're at the top of the payoff hierarchy, you're less worried about it. If you're the bottom of the hierarchy, then you have to worry, when we sell the assets of the bankrupt firm, is there going to be enough money to pay off everybody above me and to pay me off as well, right? And of course, issues can combine these different categories, as I mentioned. So you can have senior secured versus junior secured, that sort of thing. If they're in the same category, they all rank the same, pari passu. And if you don't really have to know how to say that term. As long as you say it with confidence, everyone around you will assume that you know what you're talking about. Anyway, so all those claims with the same priority are going to be lumped into a single group. Now, what about the priority here? So like I said, there's this legally mandated framework or a list or hierarchy of how we're going to satisfy the claims of creditors against a firm when this firm goes belly up, meaning that we're not just restructuring, we are actually going to liquidate the firm. So we're going to take all its assets, we're going to sell it, we're going to get a big pool of money, and then we're going to start at the top. We'll find the highest claim. We'll pay them off completely. Okay, and then we'll go down to the next highest claim, pay them off completely, and we'll keep going down as long as we can. Now, that's what the framework says. But you have to remember that the priority here, as stated in the law, is not always going to be followed. A couple of reasons for that. One, the creditors themselves may say, okay, I realize that we are in second position. You're going to pay something to third, fourth, and fifth. But if you'll just get us done and get us out of here, we'll take 90 cents on the dollar or something along those lines. So the creditors can actually negotiate a different outcome than what is in the priority of claims or the legal statutes in order to speed up receipt of cash flows, those types of things. And then, of course, when you're dealing with the court system, hey, well, the bankruptcy court / bankruptcy judge may just do something different. And when that happens, the rest of us have very little choice but to comply with it. So we do have a hierarchy. The details range from, stuff that happens after bankruptcy. Okay, we've got, employees we have to consider and government in terms of taxes, those types of things. Okay, but then we're going to get down to bank debt. Then we're going to move to bonds. So we're going to have senior secured debt near the top. And then we're going to go down to this subordinated stuff way at the bottom. And the lower you are, the greater the risk and the greater the loss severity if there is a default. Okay. All right, credit rating. So I've already mentioned this, and you hear it used a lot in the common vernacular. We want a AAA rated insurance company, or you hear that on commercials. So what does all that mean? Well, there's a number of very old line Wall Street firms that what they do is they rate bond issues according to default risk. So they have a single dimensional metric, that is, they want to assess the default risk of the bond. And the companies, Moody's, Standard & Poor's, Fitch, all three of these are very common names. You hear them a lot. And what they do, when they actually do a number of things, but in this context, it's probably their main activity is to assign a rating. So that's where the AAA, AA stuff comes from when we talk about bond issues. Now, there's two kinds of ratings. One is a corporate family rating, CFR, and this is a rating of the issuer. All right. So if you're looking at GM, okay, well, they have a corporate family rating, not a particularly high one, but nonetheless, they have a corporate family rating, okay, and that applies to senior unsecured debt. So the corporate family rating would be a way to compare one firm to another. Okay, this firm's BB, this firm's BBB, something like that. And if we wanted to think of it as where in that hierarchy it would pertain, that is going to be the senior unsecured debt. And of course, these can be notched one way or the other for specific issues. So if we get out of the family rating or company rating, then we're looking at corporate credit rating itself, and this is not on the issuer, but rather on a specific debt issue. So the notion here is we have a corporate family rating that can be whatever it is, and based on the hierarchy that a particular issue has in the hierarchy structure for payoff, it can either be one notch higher or a notch lower than whatever the CFR is. So we've got the basic rating, okay, and I think we refer to that a lot when we think of companies, but companies span the gamut frequently of the different types of bonds and the different payoff hierarchy or priority. So how does that change as we go down? Well, we start in the middle with senior unsecured debt, and we might notch up one or down one. So this is the ratings. So we have, of course, investment grade. An investment grade credit or investment grade bond is one that is rated BBB or above. So you can see that in this column. And over here we have non-investment grade, and those are also commonly called junk bonds, right? So you can see that at the top, of course, we have this AAA, and they don't use exactly the same ratings here, right? So you can see a difference in notation between the S&P Fitch versus Moody's. But anyway, so AAA, that's the highest rating. There's a relatively small amount of true AAA companies, right? So it's there's just not very many of them. So that's one of the reasons we see the creation of CDOs and those types of things, because there's a lot of demand for AAA credit, more than there are natural issuers of that AAA credit. So after that, we're going to go down to AA, and notice that we don't just say, well, all AA bonds are the same, right? So AA here in the middle, but we could also have AA plus, that's almost AAA. AA minus, that's almost gone down to single A, or at least closer to it, maybe almost a bit of an exaggeration. But you can see that there's more fine gradation than we would just say AAA, AA, and so forth. So AA and then single A's here. Right? And then triple B's, which is the bottom of the investment grade ranking. So if you have a bond that's rated triple B minus or above, that's investment grade. And there's some legal considerations regarding who invests in those, and regulations for different types of companies that say you have to have investment grade bonds in your portfolio. So there's lots of demand there for investment grade. And at the break point between investment grade, triple B and above versus double B and below, well, then there's going to be generally a wider yield gap. So as you go from double A to single A, forgetting the notches for the moment, single A to triple B, well, those are going to be a gap as you go down, right? Higher default risk, higher yield. But as you go from triple B to double B over here, well, there the jump is bigger, right? So we're essentially entering a different market. Those who can invest in junk bonds, everywhere else it's those who can invest in investment grade bonds. So double B, again, you can see that it's double B's and B's are going to be tilted, so you can notch them, right? So that is double B minus, double B, and double B plus, same for single B. And then we're going to go on down to the C's, and finally down here we have those bonds that are actually currently in default. That would be D under the S&P Fitch system. So investment grade versus non-investment grade. Remember, double B and below is going to be junk bonds or non-investment grade bonds. Triple B and above is going to be investment grade. And at least financial legend has it that Madonna was hired, and I actually think the story is true, but Madonna was hired to do a video for a bond trader conference, which is a story behind that in itself. But anyway, it was actually junk bond traders that were there, and she did a video to the tune of Material Girl. So if you're studying for the CFA, you're probably too young to remember it. But anyway, Material Girl, and I won't sing it for you, but it was something like, non-investment grade and junk bonds are also called high yield bonds. So it was something along the lines of, it's a high yield world and I'm a double B girl, right? So anyway, touting the advantages of junk bonds and Madonna worship, right? Anyway, so how about a quick question? So Topper Inc. as a CFR, that is the family rating of BA2+. Okay, their subordinated debentures, okay, are least likely to be rated what? Double B1, double B2, double B3. So or BA1, BA2, BA3. Same thing, I suppose. We were talking S&P previously. Now this is the Moody's symbols. So what does this tell us? Well, in this case, remember that the BA2, what we're looking at for the family rating, that applies to senior unsecured debt. So if we're looking at something that has lower status in the payoff hierarchy, something like a subordinated debentures, that is, way down the list of unsecured debt, okay, well, if that ticks, then it's not going to tick up to a higher credit risk. Okay, it's going to tick down to a lower credit rating, not credit risk, credit rating. So if there's going to be a difference, and there doesn't have to be a difference between the family rating and the issue rating, okay, but if there is a difference, okay, if you have lower priority than senior subordinated debt, senior unsecured debt, okay, then the likely move would be for it to go down. So we wouldn't be too surprised to see a family rating of BA2 and an issue rating for something that has lower claim of BA3, but it would be surprising to see it moved up. In fact, it would be anomalous to the point that it was scary. So you just won't see something that has lower priority tick up from the family rating. All right, so enough there on credit rating. Let's think about the risks in relying on these credit ratings. So if you're going to buy bonds, you're going to think about, well, I'm going to use these ratings that are established by the rating agencies to help select the bonds that are in my portfolio. Okay, well, there's some risks associated with that. So credit ratings do change, right? So they can change because there's a change in the credit worth or the fundamental credit worth of the company. So their operating results can improve, they pay down debt, they have better coverage ratios, all those things we'll talk about in a little while, or they could go the other way. So we could have an upgrade or a downgrade. The rating agencies do make mistakes, right? So we had lots of very high-rated bonds that were composed of subprime mortgages. Actually, I think that most of them were comprised of subprime mortgages, claims on subprime mortgages from other securitized issues. So, but nonetheless, we ended up with some AAAs that certainly didn't behave anything like we thought AAA would, given a market downturn. So, if you've got it based on subprime mortgages or something like that, well, we've seen mistakes in the past. There are, of course, issuer-specific risks that can't be anticipated. So it could be an earthquake, some sort of major litigation that comes up, those types of things. And then price spreads, of course, are going to adjust faster than credit ratings. Credit ratings are something that are administered. They're established by committees of people that sit there and look at ratings charts and those types of things. The market, on the other hand, is continually updating, right? So when we see a bond that has a rating change, it goes from, AA to single A. We're forgetting, again, the notching there. AA to single A, well, there's probably going to be a response to that. But most of the change has been anticipated by the market before the change is actually announced or the change is actually made. So remember that ratings, we are assigned by Moody's or Fitch or Standard & Poor's, that's to assess default risk. That's their unidimensional outlook. What is the probability of default? The spreads, those are set by the market. So within, a AA plus category, you can see different spreads, right? So different levels of risk, okay, and that's going to reflect expected loss. So that's what the market is worried about. Of course, expected loss is partly a function of default risk, so you have to they're not completely unrelated. But expected loss is going to be default risk and recovery rates, right? So we've got two things going into that spread measure. All right, the components of credit analysis. This is the 4 C's. So it's sort of like the 4 C's of diamond buying, right? If you have, I've only bought one diamond in my life, and I'm hoping not ever to buy another one, actually. But nonetheless, if you go to buy diamonds, you have the salesperson will tell you about the 4 C's. And let me just tell you what the code is. So they're talking about the C for carat, which of course is the size or the weight of the diamond. So carat, and the others are size, largeness, and bigness, because nothing else really matters, right? So don't believe all that cut clarity stuff. All right, so the 4 C's of diamond buying, different from the 4 C's of credit analysis. So here we're going to look at capacity, okay, the ability to pay on time, in full, all that sort of stuff. Also collateral. So if there is a problem with repayment, is there going to be sufficient collateral that we could seize, liquidate, and use to service the claims of the bondholders? Covenants, these are going to be the legal stipulations or restrictions that the bond issuer takes on themselves in the indenture, which is the document that describes the relationship between the issuer and the bondholder, where they stipulate things they must do, things they cannot do, and it's there to protect the bondholder for the most part. And then, of course, character, that's the character of the management team, and we'll get to talk a little bit more about these. What we're going to see is that while these are going to be important, in some cases very important, depending on the type of credit we're talking about, and I think what we're most interested in is this first one. That is going to be the capacity of the firm to repay. Remember, what everybody wants, right? What the bondholders want, what the stockholders want, what the trustee and the bankruptcy courts and the rating agencies and everybody involved, what they want is they want the bond to be repaid out of operating profits, or at least the cash, annual cash flows to be paid out of operating profits. So what is the capacity of the firm to do that? That's the question we're asking here when we talk about capacity. So capacity, we're going to think of a number of different important items. One is going to be industry structure. So if you read this, you think, let's see, rivalry, new entrants, substitute products, supplier power, buyer power. Have we seen those anywhere else? Okay, well, in fact, we have seen those elsewhere, right? In the equity section, we talked about Porter's 5 forces, so that's something that you want to know about. So Porter's 5 forces describes industry structure or the attractiveness of the industry. So if you've got very little threat of new entrants, there's a few product substitutes for what you do. You got low supplier power, low buyer power, and a lot of cooperation is probably not the right word, but I guess the lack of rivalry among the players. Well, that would be an amazing industry, right? So the industry structure is going to say in that case that this bond is going to have, or this company is going to have stable cash flows, and that's probably going to mean that there is a better chance that this firm will repay as agreed. So assessing the industry to begin with, well, that would be back to this Porter's 5 forces, looking at these 5 attributes. So industry fundamentals, so what about growth prospects, cyclicality? That would be another way to another industry consideration. So we can talk about the overall industry, but what about where we are in the business cycle today? What are the growth prospects for the industry given what we're looking at today? And then finally, company fundamentals. So competitive position, are we a cost leader? Are we a differentiator? Are we an also-ran? And what about the history of our operations? Do we have a coherent and workable strategy? Are we executing that strategy? All those things are going to be important when we look at the company. And then we're going to look at leverage and coverage ratios. That probably shouldn't surprise you. Ratios are a big deal on the CFA exam. I like these other things, right? So industry structure, industry fundamentals, certainly that's testable material. But when it comes down to calculating ratios, well, you're looking at something that's very testable. So something that you want to pay attention to. And if you look at things that are easy to write questions on, and writing questions on ratios, as they pertain to credit analysis is an easy thing to write questions on. I think that always is something I want to be particularly careful to make sure I understand. All right, so that's capacity, and we'll come back and talk about those ratios in a few minutes. What about collateral? So collateral, that is the value, and we're not talking book value here. It's the market value of the assets of the firm. If worst case scenarios evolve and we have to seize those assets, we liquidate them, then what's the money that we get from it, or how much money are we going to get from liquidating them, I guess is the question. So we need to think about, are these underlying assets adequate? Okay, well, a couple of things you can look at would be to examine depreciation expense. So if depreciation expense is high relative to capital spending, so we've got big depreciation expense relative to capital spending at this firm, adjusted for industry effects, those types of things. So high relative to capital spending, well, that probably means that this is a firm that's made insufficient investment, right? So they are not investing in new technologies. They're stringing things along past the point of where they may be economic, and certainly that would imply, under many circumstances, that they are low-quality assets. You got a bunch of worn-out assets at this firm, so you're going to have to be careful when you're using collateral value to assess the value of those bonds. Okay, if the stock price is less than the book value, so we have a book value, that's historical cost. There's also this notion of what is the market value of all this equity. Well, if it's lower than book value, that probably means that you're talking about low quality assets. Of course, in most cases, stock price is higher than book value, right? So anyway, so intangible assets also, if you can sell them, so patents, those types of things, would also have some collateral value that we would need to consider, all right? Covenants. We mentioned this earlier when we were looking at the 4 C's. So what are we looking at with covenants is the idea of affirmative versus negative covenants. And this is pretty straightforward. So a negative covenant, those are things the firm can't do, right? So you can't issue more debt with a superior claim. You can't pledge the same assets against debt, things like that. Okay, affirmative covenants, those are things the firm must do. Okay, they got to pay their interest and principal on time. They got to pay their taxes. They got to report their earnings to the trustee, all those types of things would be an affirmative covenant. So affirmative versus negative. And the goal here is to protect the bondholder. So if there's something we can do that would impair the value of the bonds, well, there's some game that can be played there. If you think of the value of the firm as being the value of the debt of the firm, which of course we're talking about with bonds, plus the value of the equity, well, if we're doing something that's not going to change value, if you're not prevented from doing something by covenant, okay, well then it might be possible. In fact, we can point to many, many examples of this in financial history where you do something to decrease the value of the debt. Well, if you decrease the value of the debt, value is constant, the value of the firm overall is constant, then that means that the equity has to increase in value, right? So what we're trying to do here is to protect the bondholders from unscrupulous management that does something intentionally to drive down the value of the bonds, to drive up the value of the equity. Well, you can do that once, but after that, you're going to see that whatever it was you did shows up as a negative covenant in lots and lots of bond indentures. Okay, and finally, character here on our 4 C's. So the character of the management team, can they develop a sound strategy? Can they implement it? Do they have a past history of bankruptcies? They got lots of restructurings. Okay, their accounting policies. Okay, are they really aggressive? Okay, do they have to do frequent restatements? Those would both be indications that we need to be careful when dealing with that management team, right? So if they're being aggressive, they're trying to overstate earnings, or that's a big jump, but aggressive, then we would be worried about the quality of the statement of earnings and might think that it was too high. So if that's the case, then you're going to be suspect of character, and that's going to make you say, well, I'm not sure I want to buy that bond. So fraud, of course, or other legal problems are going to be a big deal, and actions that favor equity holders over bond holders. Well, we just talked about the division of value between equity and debt. Okay, what about ratios now? So we've seen lots of ratios in the curriculum, and that's something that you certainly want to be on top of. These ratios are very similar, and there's actually some that are exactly the same as what we've seen elsewhere, but this is in some cases a little bit different and has a slightly different emphasis, so you probably want to pay attention to these in terms of how we would use ratio analysis in the process of analyzing a credit. So what we're going to focus on is 2 things: leverage ratios, how much debt do we have, and we're of course going to measure that relative to some metric that would scale it for us, and then coverage ratios. So this has to do with our ability to cover interest payments and the like. So our profit and cash flow metrics, EBITDA and EBIT. So the EBITDA, of course, is sort of a crude proxy for free cash flow to the firm. EBIT, I suppose, could also be considered a proxy for that. We frequently refer to that as operating cash flow. Funds from operations, this is going to be NICO, where then we add back all of the non-cash stuff, deferred taxes, depreciation, amortization, those types of things. So similar to CFO, but without working capital implications. So funds from operations, or FFO, something that's used a lot by the rating agencies. And then, of course, free cash flow, either before or after dividends, would also give us some measure of the cash that the firm was throwing off, so that we could compare that to the obligations of the bondholder, right? So their responsibility for making interest payments in particular. So we've got EBITDA, EBIT, funds, FFO, and then cash flow or free cash flow. Want to be aware of all of those. I actually think that these top 2 are probably going to be a little more important, at least in this reading when we're talking about credit analysis. So leverage ratios. So leverage ratios tell us how much debt we have. The higher the leverage, okay, the higher the credit risk. So you can think of yourself as being someone who makes a lot of money. You own a home. The home doesn't have any debt against it, so you have very little debt. Well, you're going to have lots of assets and very little debt against them. Well, that's going to give you a high leverage ratio, and therefore, lower leverage, and therefore a greater credit rating, or make you a better credit risk. On the other hand, if you borrow every dime you can borrow, so compared to your assets, you have lots of leverage, then you're going to have higher credit risk. And if you were a bond issuer, you would have a lower credit rating because of it. So we need to adjust debt to include all the obligations. So this would include those that are recognized on the balance sheet and those that aren't. So if we have underfunded pensions, well, we want to bring that on the balance sheet. Off balance sheet stuff, something like an operating lease, we'd want to bring that online, right, or onto the balance sheet. DTLs that are expected to reverse, well, we want to make sure that we're accounting for those in the way we should. So when we're calculating these leverage ratios, we can use debt to capital or debt to EBITDA. So a higher ratio here means higher leverage. So we notice that debt is in the numerator. In one case, we're comparing it to a flow concept, EBIT. The other, we're comparing it to a capital or a stock concept. But in both cases, debt being in the numerator, we put, I was going to say the bad thing in the numerator and the good thing in the denominator, but that debt is not bad. We're just comparing, that's what we're scrutinizing, right? So debt, if you have a lot of debt, that's going to worry us. So, and it's not just a lot of numbers of dollars of debt, but it's debt relative to something, in this case, to capital or EBITDA. We could also, and we may want to adjust the capital for a write-down of goodwill. So goodwill has no value apart from the firm, so we may take capital and just write it off. So FFO to debt, so our funds from operations to debt. Now we have debt in the denominator. So the higher this ratio is, that indicates that we have more funds from operation to whatever our debt load is. So a higher ratio here is going to mean that we have overall lower leverage. So and the coverage ratios, so we're looking at measures of earnings relative to interest obligations. So now instead of looking at how much debt we have, we're looking at the ability to service debt. And of course, EBIT to interest expense, we see that one a lot in the curriculum. We also have seen EBITDA to interest expense. So EBIT to interest expense is a little more conservative because we're not adding back depreciation and amortization. But probably the key thing here is to make sure that you use whichever one would make a valid comparison. So if you have industry data based on EBITDA to interest expense, you wouldn't want to use EBIT to interest expense for evaluating your particular firm. So credit ratios. How about a quick example? So here we're looking at credit quality, and you can see we're given some data. So we have two firms, York and Zale, and we have the industry average over here. So what we're going to do is we're going to compute some ratios. We're going to take the industry average as the standard, and then we're going to look at Zale and York and see how they would fare relative to the industry average. But before we can do that, we also are going to have to go in and make some adjustments. So York has goodwill of $500. Well, remember, we're going to reduce capital by $500 because goodwill has no value apart from the firm. They have operating leases. Now remember, operating leases are off balance sheet, right? It's financial leases that are brought onto the balance sheet. So these are operating leases that have a present value of future cash flows or present value of payments of $900. Well, we want to treat that like it was debt, right? So we can adjust there. So Zale has a net pension liability of $200. So we're going to assume this is one that's not on the balance sheet. So we're going to say, well, that ought to impact the debt that Zale has. They have no operating leases, so we don't have to worry about that. And then the industry, on average, has $200 in goodwill, so we can take that and we can subtract it from total capital there. Present value of operating leases of $200. Well, again, these are operating leases, so we're going to take that and go back up here and adjust our debt for that $200. So we're making the adjustments. We got the financial statement data. We're going to make these adjustments, and then we're going to compute ratios. Right? So you make the adjustments, then you compute the ratios. So here you can see that we're going to include the operating lease obligations and net pension liabilities. We're going to put those into total debt and calculate the debt to capital ratios with and without goodwill would be one way to do that. I personally prefer the without goodwill metric, but nonetheless, either way. So if we're looking at this is our revised data. So EBIT didn't change, FFO didn't change, and interest expense didn't change. But notice that total debt, well, here we had to add the $900 to York, we had to add $200 to Zale, and we added, I think it was $200 to the industry average. For total capital, well, we have $4,000 in total capital. If we adjust out goodwill, we would have $3,500. So what we're going to do, if we need total capital in our ratio, we're going to do it both ways and see what that means. But the red lettering is going to mean that it has excluded goodwill from our measure of total capital. And then over here, same thing over here. Well, we had $200 in goodwill. Well, we're going to take the original capital. We're also going to have $5,800. That is the capital minus the goodwill, and we can compute the ratios in both ways, both stating capital as it is stated in the financial statements or as after it is adjusted for the subtraction of goodwill. And if we do that, what we see is that if we're looking at EBIT to interest, 13.8, 14.1, 14.0, what does that tell us? Well, I mean, it is true that York is a little lower than the industry and Zale is a little higher. I would probably just contend that these are all in the relevant range. So they have interest coverage that is, in line with their industry. So it doesn't have to be exactly equal to 14 to, say, okay, well, this is in the ballpark, right? So I would say these are in line and probably move on. So FFO to debt. So we're putting our measure of cash flow in the numerator, debt in the denominator. Remember, a really big denominator then, got lots of debt relative to FFO, is going to make this ratio low. So FFO to debt is going to be 15.8 for York versus 29 for Zale. Notice that Zale is a little above the industry average and York is a little below. So that would tell us at least as one piece of evidence, would say, well, based on funds, that is funds from operations, looks like York has a little heavier debt. If we then say, let's look at magnitude of total debt, we can take debt to capital. If you compute that without subtracting the goodwill, you get 47, 41, and 43. And if you do subtract the goodwill, well, you can see, the 54 and 48 on the outsides there. So the point here is, when we look at York, okay, well, we'll see we've got a higher FFO to debt, a lower FFO to debt. That's where high leverage, meaning big denominator, makes for low numbers. And then when we look at debt to capital, so there's a high number that would indicate lots of debt, since you have debt in the numerator. Well, you've got debt higher than Zale or higher than the industry average. So what I would conclude is that our coverage ratios were about the same, but that York was, in fact, more highly levered, right? So Zale appears to be more creditworthy just based on their position, right? So all else equal, you have less debt. That's probably going to be a good thing. All right. Excuse me. Yield spreads looking at level and volatility. So what are they, and what impacts the spread itself, how it opens and closes. So yield spread is going to be based on two things. Okay? It's going to be based on credit spread. So that's what we normally think of. Well, let's see. If we're looking at a spread relative to treasuries, okay, what's the credit risk associated with this firm? It's up here. But also, liquidity is going to come into play. So if you have a smaller issues are usually less liquid, but you're going to have a greater spread. So we're looking at both the level here and the volatility. So what we see is that yield spreads here, they tend to be more volatile for lower quality bonds. So, the ups and downs of the market or interest rates, or the ups and downs of yield spreads, tend to be much higher in junk bonds than investment grade bonds. Just a fact of life. Those rates adjust more quickly, or more fully, or we're more sensitive to a change in interest rates, might be a way to think of that. So what about factors affecting yield spreads? Well, the credit cycle, so we're at the top of the cycle, the bottom. Okay, economic conditions, so look at the macro economy, what's going on there. Market performance, this would include the equity market. So if you got the equity markets raging, everything's looking good, then that's going to, all else equal, lead to lower yield spreads for the fixed income market. Okay, broker-dealer capital, so these are the people that make the market. To the extent that they have lots of capital, we're confident that they'll be able to stay there and make a market. If that capital erodes, well, then we're going to see that that increases the risk of buying a bond. If you buy it, you have to sell it, you have to hold it until maturity, well, that's going to be problematic. Okay, so, and then finally, supply of new issues. Well, if you got a bunch of people dumping supply onto the market, okay, well, that means what? Well, if you dump supply into the market, you're going to drive down price and you're going to drive up yield. Okay, well, so looking at the pencil trick, right? So we're looking over here for when the pen's level, you're pointing towards the coupon rate. Over here, you're pointing towards par value. Well, what happens if we have a supply of new bonds? There we go. I forgot where I was talking about for a moment. That means that there are going to be lots of supply. It's going to drive down prices, and it's going to drive up yields on that particular issue, which is going to increase the spread for that issue. So I think it'd be a good thing to be able to go through and think about each of these 5 factors and how they affect yield spreads, something that makes for easy test questions. Easy test question writing. Anyway, so let's see, return impact on of spread changes. So when the spread changes, right? Now, we can talk about interest rate changes, right? If the spread can be constant, interest rates go up and down. Well, that's not what we're talking about. What we're talking about is, everybody else in the market went down, you stayed up high, okay, or you went up when everyone else was constant, or some combination of the two. So the return impact is simply the percentage change in price of the bond. Well, that sounds a lot like duration, or duration and convexity, which is exactly what we're going to do. So looking at an option-free bond, the return impact is going to be the modified duration times the yield spread. Notice the minus sign. Why is that there? Well, the minus sign is to remind it, well, it's not to remind us, it's there to account for the inverse relation between prices and yields. So we're back to our pencil trick. If you increase yields, you decrease prices. Okay, if you decrease yields, you increase prices. So since duration is best defined as the approximate percentage price change for a 1 percentage point change in interest rates. Okay, well, what we see is that, if interest rates are going up, then the value of the bond's going down. So the return impact here, well, that's where the negative is going to come from. So minus the modified duration times the yield spread. And then we're going to add to that a convexity correction. And we talk about convexity corrections elsewhere in the curriculum. Okay, and this one is a little bit different. So here we've got this 1/2 up front. Okay, we got to remember that we're doing the yield spread squared, and then this is our convexity number. You've seen this elsewhere in the curriculum where the 1/2 doesn't show up. It's just convexity times the yield shock squared, or the yield spread squared, excuse me. So this should say change in yield spread, sorry, change in the spread square. What do you do about that? Sometimes you see the 1/2, sometimes you don't. This has to do with the computation, the underlying computation of how we compute convexity. So you can't see through to, oh, I need to use 1/2 here and I don't over here, because we're not looking at the derivation of the formula. But we do have two formulas that talk about the impact of convexity as a correction to a duration estimate of price change in the bond. So what do we do about that? Well, if we're talking about return impact, okay, that's what the question's on, then you're going to use the 1/2. That's the best I can do. Unfortunately, there was a time when we had 3 different definitions for duration in the curriculum, so at least we're down to just 2 for convexity. Duration, I think, will be the same everywhere. But nonetheless, you're just going to have to remember that if you're talking about return impact, then you're going to have to plug that 1/2 in. It just has to do with the denominator in the calculation of convexity. Different authors, so we see different authors from the various readings in the curriculum. All right, so we want to scale convexity based on the duration squared. Now, what does that mean? Okay, first of all, don't think of this as some sort of economic principle. We're going to scale duration based on, duration squared. Well, I'm thinking, let's see, volatility increases the square root of time, and 2 plus 2 is 4, and if you are original, then you like Dr. Pepper, and so where is that? Well, all we're saying here is the data can be stated where you're given duration of 4. Okay, and convexity in the form of 21.8. Well, if you take 4 and square it, you get 16. Well, the magnitude of duration squared plus the magnitude of convexity should be the same, right? So if we see the counter example here, so we have duration of 5, but they give us convexity of 0.327. Okay, well, so if you take the duration of 5, square it, you get 25. Well, 25 and 0.327 are not in the same range. So what we have to do is we have to adjust this convexity, to be 32.7. So 25 is the squared duration. It ought to be in the basic same magnitude as the convexity number when we put it into this problem. So remember, it should be something close to duration squared. This is just a safety tip because we have more than one formula and people sometimes lose track of how these numbers were derived. All right, so what about another problem? So a bond with a duration of 6.5 has an estimated convexity of 0.634. If the bond's yield spread widens by 50 basis points, what is the impact on the investor's return? So it's an impact on a spread change. So what is the impact? Well, this would be a good place to stop the video and go through and work the problem. Okay, but if you don't want to do that, we'll just keep on going here and work it. So we're going to do duration. Remember that we're going to have duration times this change in yields. Okay, in this case, we're looking at spreads. Is going to be the duration effect. We also have to put a minus here. Sometimes you'll also see that written as a -1 times duration. Okay, and then we're going to add the convexity effect. So what we've seen elsewhere in the curriculum is we take the convexity effect, which I'm going to abbreviate with C, and we multiply that by delta Y. Okay, in this case, Y stands for yield spread squared. What we've got to remember here is 2 things. First of all, okay, we've got to remember that we're going to add the 1/2, right? So that's something we haven't seen before. We know to do that because we're talking about a question on return impact. Okay? And we also have to remember that we need to make sure that the magnitude of the duration number squared is in the same order. Well, the duration squared is in the same order of magnitude as convexity. So in this case, we take 6.5 squared. Well, we don't get anything close to 0.634, right? So that means that we've got to adjust this 0.634 so that it has roughly the same magnitude as 6.5 squared. And if you do that, what you're going to see is that it turns out to be 63.4, right? So getting rid of my chicken scratch, okay, and going back to our get my pen straightened out here. So going to the answer, what we're going to see is that the anticipated price change is going to be 3.17%. So we're going to get, and yields are going to widen, so we're going to see an increase in the required return here going up. So if yields go up, then prices are going down. So in this case, minus 3.17%. And here's the formula, 6.5 times the change in yields, 1/2 times 63.4 times the change in yield squared. Okay, remember you got to match the duration squared, got to match in order of magnitude the convexity number to make all this work. And that just because there's more than one way to calculate it, right? So you can either use 0.005, or you could use 0.5. There's just different. If you line those up, then you'll be right. Squared magnitude of duration versus the magnitude of the convexity number. All right, high yield bonds. Certainly an interesting investment arena here. Lots of history, lots of color, books written about it, all that sort of stuff. There was lots of books. It seems like at the end of the 80s, there was a bunch of books that came out that have sort of become classics. Although if you read them, you feel like you need a bath afterwards because they use so much foul language. But anyway, so just as a warning there, those are not something you want to read with your kids. Anyway, so high yield bonds, so they have higher default risk than investment grade. That's why they're high yield or junk bonds. Okay, and so we're going to have when we analyze these, we're going to be much more focused on loss severity. So the probability of default goes up. That naturally begs the question, well, if we're going to have default, what's the loss severity going to be? So sources of liquidity are going to be important for high yield issuers, and the grand champion of liquidity would be to have cash hanging around, right? So if you got lots of cash, then you could write a check and make things better. So working capital would be next. So current assets minus current liabilities in its most simplistic definition, working capital. A CFO, can we rely on cash flow from operations? So we've got balance, we've got cash, we've got things that we've already generated in terms of earnings, right, like accounts receivable, offset against our accounts payable, of course, that we're just waiting to collect. That would be second. And then CFO, that comes from the operations that we are still working on here. So next month we're going to sell some stuff. What about bank credit? Well, that would come then. Equity issuance, way down at the bottom. And I suppose asset sales, that means you're, lining up in the parking lot and selling off the typewriters and computers or something like that. All right. So thinking more through these high yield bonds, we need to, if we're going to understand the credit risk associated with high yield bonds, we have to project our future earnings and the cash flows, and we have to do it with some stress testing. So what's going to happen if sales go down, or recovery periods extend, or whatever it happens to be? We need to do some stress testing, which of course is going to be vital to in the economic sense, but also important from our ethics material, right? So our ethics tells us that we need to do stress testing, and has some comment on that. So analyze the debt security. Well, if we're going to look at our future earnings, we're going to estimate the leverage and the loss severity for each level of debt. So if we've got senior secured, and then we've got junior secured, and then senior unsecured, and all the way down to debentures, well, how does leverage change as we eliminate each of those levels? What is going to be the loss severity if we were buying one of the lower versus one of the higher priority securities in these different scenarios? Okay, there's also this common phenomenon that if we're talking about a high yield company or a junk bond issuer or a junk company, they're going to have a top heavy capital structure. And what that means is top heavy means that this firm is borrowed a lot from banks. So typically we see that high yield issuers, that is companies rated BB and below, rely on bank debt more than an investment grade company. Well, if you have lots of bank debt relative to your other types of debt or relative to your assets, then you're top heavy. And the reason that's important is because if you've already borrowed a lot from the bank, well, the bank is a quick source of borrowing, right? So if there's some sort of short-run problem, then you can go get liquidity at the bank if you haven't already borrowed every penny they'll lend you. So if you have lots of bank debt, you're top-heavy, you have less ability to increase borrowing if there is some sort of stress scenario. Cash flows are getting squeezed for whatever reason. So and that means if you can't borrow quickly, then you're not able to react to the stress of whatever the situation is. Well, that means you're going to have higher probability of default and probably a lower recovery rate for that unsecured debt. So top heavy means lots of bank debt, which means that you're going to have a higher default probability there. So we also are going to have to talk about, in regard to a high yield bond, we're going to have to talk about the corporate structure, literally how the corporation is structured. So the debt is usually issued, in my experience, by a holding company, okay? And so we've got the holding companies, we've got the subsidiaries. Well, we could have what's called structural subordination. So if you're looking at a subsidiary, okay, well, they may have the requirements on their bond so that they have to service their own debt before they can upstream any dividend payments to the parent. So even though the parent is, the holding company or the parent is looking at all the operations for the subsidiaries, technically they own those subsidiaries, or I guess that's a good way to say it, own. You would think they would have claims on the cash flows generated by those subsidiaries, but we can have structural subordination where debt issued by the holding company is actually subordinated to debt that has been issued by one of the subsidiaries. So the holding company debt is effectively subordinated to subsidiary debt. That's going to be a bad thing if you are buying bonds that are issued at the holding company level. So in terms of covenants, of course, we're going to be wanting to address some of these things we've talked about. So we could have a change of control put, which is a bond covenant which says, look, if the ownership of the issuer changes, that is, someone buys the issuer, then the bondholders can put their bonds back to the company at some value, probably par. Restricted subsidiaries, okay, this is targeted at what we just talked about with the structural subordination. And what that says is, look, we're going to loan money to the holding company, but then the holding company, who's in charge of the subsidiaries, is going to be prevented from allowing any of the subsidiaries to issue debt in a way that would create structural subordination. So we're going to restrict that if we can. Limitations on liens. So look, you're using some asset as collateral. Well, you can't go and issue more debt against that same asset. And then restricted payments. This is thinking in terms of equity holders. So, frequently we'll see a firm that is paying dividends, although most junk companies don't, but if they're paying dividends, there'll be provisions for continued dividend payments under, some controlled environment or controlled circumstances. Okay, but what they're not going to let them do is pay out in any case, whether it's a high yield bond or any other bond, is pay out huge dividends, right? So you can't liquidate the firm, pay everything out as dividends, and then when the next coupon rate rolls around, just tell the bondholders that you don't have any money. All right, so those are high yield bonds. We started off with the general category of investment grade corporate. So let's talk about a couple of other types of credit. Sovereign bonds. So sovereign bonds, these are bonds issued by federal or national governments, so countries, Peru, Japan, the United States. So in this case, we need, like any other issuer, we have to analyze the ability to repay. So, what do their economic circumstances look like, all those types of things, all that's going to be important. But with a sovereign issuer, we also have to investigate the willingness to repay, because you can't force a sovereign to repay bonds. So if you have bonds for an operating company, so let's say you live in the U.S. and you have an IBM bond. Well, if IBM has something of value, cash, operations, buildings, whatever, and they just say, I don't think we're going to pay you. Well, they can't say that, right? In the limit, we're going to send in federal marshals, seize assets, liquidate them, and pay the bondholders. So, but that's not true with a sovereign. So it's not just ability-based. Okay? It's also going to be willingness-based. So the bondholders just don't have any means of forcing an unwilling sovereign to pay the debt. So a sovereign issuer can declare a moratorium. That just says, well, we're not going to pay interest for a while. And they can also renounce the debt. We've seen that more than once on this particular planet. So willingness becomes a big issue. Okay, the bonds of a sovereign issuer can be issued in either local currency, that means their own currency, so that, for instance, the Canadian government issuing bonds in Canadian dollars, or they could be issued in foreign currency, so the Canadian government issuing euro-dollar bonds, or euro-based bonds, excuse me. So we have these, so either way they can do that, and these two different types of bonds, local currency and foreign currency, will probably have two different ratings, but the rating on the local currency is going to be the ceiling, right? So there's a higher default risk on foreign currency bonds, because in everything else, all the risks that you have with local currency bonds, with foreign currency, you also have to worry about the sovereign coming up with the foreign currency. Local currency, they control it, right? It's the Canadian government that controls the number of Canadian dollars. So they have an army of sorts that can collect taxes in Canadian dollars. They don't have an army that can collect taxes in euros, at least not under normal circumstances. So anyway, so local versus foreign currency. Local currency is going to have a lower credit risk. Foreign currency is going to have a higher credit risk. because we don't control, as a sovereign, we don't control the foreign currency. So analysis of sovereign debt, so institutional effectiveness. So this has to do with their commitment to repay debt, the organization of the government, the secession from one regime to another, all those types of things. All that's going to speak to their commitment to repayment. Economic prospects, so that's going to be things like growth rate, per capita income, demographics, standard of living, international investment positions. So where are they on foreign currency reserves? What does their external debt structure look like? Are they going to have to go to great lengths to come up with the foreign currency if this is a foreign currency denominated bond? Those types of issues. Financial flexibility, the ability or willingness to increase taxes or decrease spending to service debt. So many would claim that we have the willingness to increase taxes, but not the ability to decrease spending in, let's just say, many of the world's developed countries, right? And then monetary flexibility. This has to do with the effectiveness of the central bank, the central bank's ability to set domestic monetary policy, pursue those objectives in a credible and consistent fashion would be something along those lines. And then finally here, municipal bonds. So these are bonds that are issued by governments or agencies below the national level. So in the United States, that could be the state government, it could be a city government, a county government, a local school district, really any taxing issue, taxing entity other than the federal government. So, I happen to live in Utah, so the state of Utah. I live in Utah County, so Utah County, Provo City, Provo Independent School District, all those entities would be capable of issuing municipal bonds. The distinguishing factor, of course, with a municipal bond more than anything else is that it's not subject to federal taxation. But in this case, they want us to talk about a couple of other things. That is that we have two kinds. GO bonds, general obligation. That's backed by the full faith and credit of the municipality, meaning that it's backed by tax revenues. So the local government's ability to levy and collect taxes is going to be paramount, as well as the strain on those tax revenues as it exists with reference to other issues, bond issues that they have outstanding or other debt repayments, as well as the load they carry for, providing services to the citizenry and that type of thing. Then we have revenue bonds. Revenue bonds, these are bonds that are serviced from the revenues of a specific project. So a great example would be a toll road. So you get a county or a state government that wants to build a toll road. What they can do is they can issue revenue bonds, and then repayment of the bonds is going to be done by the revenues generated by the toll road itself. So if you want to analyze these two different types of bonds, GO bonds, you're going to look at tax revenue. It's going to be dependent on the local economy. So what's employment look like? How diverse is the employment base? Is there one big employer and they pull out, then everybody is has to move? How rich is the community or affluent, per capita income? What is the depth and breadth of the tax base? Is it just a few people paying taxes, or is it going to be a broader, flatter base? Sales taxes of capital gains, those are going to be cyclical. So how cyclical are they going to be? And what's going to be the stress on the repayment in the downturn of a cyclical of a cycle? Long-term obligations. So have they made any promises? Okay, so you probably can't think of municipalities that would make promises, say, for pension liabilities to their employees, being facetious with that. Of course, I live in the United States. We've seen lots of that going on. It's made a basket case out of a number of states. Anyway, so do they have these other long-term obligations? And then what about their reporting? Do you see inconsistencies? Is that going to throw up a red flag? All those things are going to go into analyzing a GO bond. And if you look at that, well, that's not very different from just looking at an operating company, right? There's really more similarities than there are differences. Some things we have to worry about, but generally we're looking at the ability of the firm to repay. We want to look for red flags, those types of things. And then finally, if we're looking at revenue bonds, well, we're going to look at debt service coverage, so the revenue to payments. So, of course, the more revenue we're generating relative to the payments that the bond is required to make, the better off we're going to be. We're also probably going to want to see some covenants in there that make sure that the revenues from that project are devoted first to repaying those bondholders. So that is our credit risk material. I think it is highly testable. It's mostly qualitative. We did get some ratio stuff in there. It'd be a great exercise to compare the ratios here to the ratios that we use elsewhere, and see what you'll see is that there's great similarities, slight definitions. We don't use the funds from operations a lot elsewhere in the curriculum, but if you can compare those two, see where you find similarities, where you find differences, that'll help with understanding them in both contexts, elsewhere, say financial statement analysis, here in terms of an analysis of credit risk. But other than that, we're looking at sort of the soft principles about credit and how we ascertain the ability of the entity to repay, and how much faith we have in that ability, I guess, is the bottom line. So very testable material. I think it's easy to write questions on this, not just on the part where you'd be making calculations. So this is material that you probably want to make sure you get on top of before exam day. Good luck.